I want to focus on valuations and just how high they've been. What have you seen this year in terms of pushback or reluctance to do deals on the part of private equity firms because of those high valuations?
This year has really been 2019, sort of a repeat of 2018 in terms of valuations, the peaking of the 10, 11, 12 times range, the high multiples even above that in the healthcare sector. I don't see there being a lot of pushback on these transactions. I just see a lot of larger equity checks being written to basically chase the best assets that are out there right now. They have tons of dry powder to do it, and if they want an asset and it makes sense for their portfolio, they're going to write a larger equity check for it.
You said they have a lot of dry powder, and that's the key. How much are these deals being driven by the amount of cash that they have versus the idea that perhaps there's value in these deals being done?
Yeah, it's a tricky wicket to figure that out, right? We've got, I think it's anywhere from $2 trillion globally of dry powder. We've got sovereign wealth funds coming in. You have family office joining the party as well. And so you have all of this capital on the side from the investment standpoint. GPs wanting return, right? The exits have slowed down. But then you have access to the credit markets that is huge. I mean, you have low borrowing rates at the traditional regular banks. You have access to the capital markets, and you have access to direct lenders who are now at the table doing much larger deals and doing it alone. So I almost feel like these valuations are a new norm, even if you start to slightly slow down.
What could potentially trigger a shift here? I mean, there's a concern as valuations get higher and higher and profits perhaps don't match pace.
Right.
And you have 70% of all the companies that IPO'd, I believe this year, were cash flow negative. At what point does this become a real fundamental problem?
Well, I think if you're investing in certain sectors that could be cyclical, that could be a problem because you're you're in the automotive space. Maybe you are heavy into retail, the old school brick and mortar retail. That stuff is going to suffer. It already is suffering. Transportation is already showing a little sign of weakness. If we start seeing housing slow down and you're in building products, I think it's just going to force the investors to pick a little bit more of a heavier focus on the non-cyclicals. So spend a little bit of time in the food and beverage space, spend a little time in automotive aftermarket space. It's going to force their decision making to a place that it could be a little bit more stable and cycle resistant.
What are you looking for in terms of 2020 M&A and just activity in general, particularly in the middle market space, because that's where you focus,
That's where we focus. So at Huntington, I sit inside of Cleveland, Ohio, but our bank is headquartered in Columbus, and so our footprint is the entire Midwest. So we see these middle market companies that private equity comes in to buy every day. Oftentimes we bank them. I think we're going to see a pace in 2020 that is really the same of 2019. We're hearing from our companies, from our PE buyers, that they are very optimistic, that revenues are up, that they have CapEx spend budgets in mind to keep up with the growth. So I do think you're going to see another 2020 year that matches 2019 in M&A, while the economic indicators are as favorable and the market is favorable.
So you think that valuations are going to increase to a similar degree as they did this year?
I think they're going to stay relatively the same, but I think certain sectors are always going to push the edge: IT, fintech, healthcare.